welcome to today's podcast, fourth episode of the CFA Society podcast series, where we look at financial literacy items. I'm your host today, Andreas Spyrides, member of the board of the CFA Society Cyprus, and today I have with me Demetris Demetriou, the CRO of Bank of Cyprus, and we're going to touch upon items about the banks in general, what their role is in the economy, and specifically touch on the risk side of the banks and what risks the banks are focusing on. Thank you for joining us today. It's a pleasure to have you in our podcast series. Demetris is a CFA, a proud CFA member of our society as well. Yes. Welcome to the episode.
Well, thank you, Andrea. It's a pleasure to be part of this podcast series. I know that financial literacy is a matter which is close to heart, both of the CFA Institute, but also the CFA Society in Cyprus. I think we have pioneered that CFA Society, the aspect of financial literacy, and I'm glad to be part of this initiative.
Thank you again very much. So without further ado, I know you have a very busy schedule. So let me tackle just in the podcast. What is the role of banks, just to set the scene? Why do they exist?
Well, banks, I think let's focus on commercial banks or wholesale banks, as we call them, which is the traditional, let's say, form of banking. Mm-hmm. Well, there are a couple of main activities that are usually performed by commercial banks. One is the safekeeping of deposits, and the other one is, of course, extending of lending. Now, an important role of banks is to be a catalyst of economic growth. And how do they do that? They do that by borrowing, raising deposits or borrowing from depositors in the short term. Usually deposits are either overnight or 6 months, 1 month, 1 year is the maximum. And extend lending, which they do both to retail individuals but also to businesses, which can be multi-year. So, for example, it allows a retail individual to borrow for 20, 30 years to build their house, or for 5 years to educate their children. In the same manner, it allows businesses to borrow to finance their capital expenditures and to finance their investment projects, which usually require a multi-year repayment. It is this role of banks which is key, and it is this important role which acts as a catalyst of economic growth. Now, of course, the role of banks includes many other activities. It involves the facilitation of transactions, which can be in the form of payments, which facilitates trade. It can be in the form of guarantees, which can secure contracts between two parties, exchange of currencies, etc., etc. Wealth management is also an area which most commercial banks have as an activity which they do in addition to their traditional banking activities.
Thank you very much. I believe that sets the scene really well. Being a chief risk officer, I'd like to focus a bit more on the risk aspect of the banks and how banks manage their risks. So we often hear about credit risk, market risk, liquidity risk. Those are the more traditional types of risks. So what are some less obvious risks and that significant risks that keep you up at night?
Well, the main types of risks faced by banks, you're right. I mean, they are credit, market and liquidity, and operational as well. These are the three key types of risks. Now, credit, market, and liquidity are risks that the banks have, let's say, honed their skills, developed their models over a number of years. They have seen how managing of those risks can be done through various crises, looking at what worked and what didn't work and adjusting accordingly. Well, the new types of risks and those that usually both risk officers but also CEOs of banks awake at night are the more recent technology-driven kinds of risks. For example, cyber, which is a growing, let's say, and fast-changing type of risk. Fraud, which again is something that has, given the technology, evolved quickly over the last couple of years, and it is a main, let's say, area of interest of banks trying to secure the transactions of their clients. But there are other types of risks as well, which banks are paying more attention recently, like ESG risks. ESG is a key area of focus of the European Union and the European Central Bank, and banks have worked a lot over the last couple of years trying to understand ESG risks, focusing on the environmental and climate-specific type of risks, developing their understanding data so that they can correctly measure and manage these risks, and also help clients understand and take into account these risks when they take their business decisions.
Just to understand what you mentioned now at the end, can you give a quick example of how climate risk affects banks?
Well, of course. Well, let me just say that here in Cyprus we have pioneered the banking sector in Cyprus has created an ESG scoring mechanism, which is bank-wide. So the same type of scoring takes place irrespective of which banks serve clients. And in this way, a client which has done this ESG scoring on one bank can use this scoring on another bank. Now, what does this do? Basically, it's in the form of a questionnaire, which helps clients, first of all, develop their thinking of how of what ESG risks they face, and also provide them a score of how they score, and also provide, let's say, recommendations on how they can mitigate the risks that they face according to the scoring mechanism.
You mentioned ESG risks. Just to understand this a bit better, can you give me a simple example of what an ESG risk is?
Well, ESG risks are usually subdivided, environmental risks are usually subdivided into two key categories. Physical risks, which basically arise, let's say, a business has operations in an area which is prone to earthquake or flooding risks. So an environmental event could disrupt operations of that business. And transition risks. Transition risks has to do with the costs that businesses face or will face in order to meet current or upcoming regulations or laws that a country is imposing in order to meet its own environmental requirements. Now, a good example in Cyprus, the banking sector has pioneered the creation of a uniform ESG score. This score is provided through Artemis, which is a company which also does credit scoring for secure businesses, and also acts as an information exchange mechanism between banks. So clients of any bank in Cyprus can receive this score, which they can use for their own purposes, but they can also share with the banking institutions that they cooperate. Good to say that this initiative also provides recommendations to clients of how they can mitigate the risks, the environmental risks that they face. So we hope that this will help both businesses, but also banks to promote the transition into a more ESG-friendly environment.
Thank you. So you mentioned something very, very important. Thank you for this, the Artemis discussion. So how important is it, basically, the collaboration and the information sharing between the banks in order to tackle these novel risks? Are there any other examples like Artemis that you mentioned, or?
Well, information exchange is critical, and I will explain why. One of the common problems that banks face is the so-called adverse selection problem for borrowers, which basically means that at any point in time, the borrower theoretically has more information about their own financial status than banks, so has an incentive to share the information which is going to be taken positively by the banks to achieve their objective of receiving a loan. So a client, in theory, has an incentive to share part of the information and withhold the information which will not be to their benefit to share. And in this way, be approved for a loan, which will then lead to a default.
Okay.
Now, the information sharing creates a situation where a borrower knows that if it tricks or fools one bank, that information will be shared with the other bank through the information exchange mechanism. For example, they will receive a bad credit score or a negative flag in their Artemis report, which the other bank will take into consideration when they consider extending of credit. So this basically eliminates the incentive of a borrower to share only the part of the information which is to their benefit and not the entire information.
Or false information.
Exactly. If information is shared fully and transparently, that helps in the smooth functioning of lending and the banking system in general.
Thank you for the very elaborate answer on that. I believe that the regulators also now encourage, and they have some mechanism about sharing information between the banks. Is that correct?
Well, that is true. That is true because the regulator has exactly the same incentive to gather maximum information from banks, and now they are building their own models so that they can analyze huge amounts of information that they gather from banks, and in this way understand the financial status of banks without doing inspections like they did in the past, just by real-time sharing of information. We've seen over the last years that the regulators have requested API links between the data systems of banks and their own systems, so that they can have real-time exchange of information, which they can use for doing stress testing of the situation of banks, and also for uncovering areas of weakness and doing peer comparisons between banks in different regions in the Eurozone, for example.
Hold that thought, because I want to ask you a few more questions later on about stress testing specifically. So we've seen vast progress on the regulatory side, especially since the great financial crisis of 2008. What are some challenges that banks face in this evolving regulatory landscape, and how can you explain a bit the evolution of regulation since the great financial crisis?
Sure. Well, the challenges is that the regulatory landscape has become significantly more complex. So banks now require significant investment in systems, in staff, and in expertise in order for them to meet continuously changing and more complex regulations. But these regulations are all for a good cause. You mentioned the Great Financial Crisis. Well, in the Great Financial Crisis, banks in the US held capital somewhere in the realm of 4 to 6%, which proved that it was not enough to absorb a period of unexpected stress. The burst of the property bubble and the default of banks and impact on insurance companies like the AIG was so severe that capital was completely wiped out, and it had to be that the taxpayer had to take the burden in order to safeguard the system and not cause a huge economic depression in the US. Now, since then, things have changed materially. Just by way of an example, the key capital that banks are required to hold now is called Pillar 1 capital, is 8%. So higher, higher than what it used to be during those times in the US. And on top of that, you have other buffers that banks need to maintain, which makes it common, for example, in Cyprus, for banks to hold capital in the region of 18 to 20% plus. These buffers have been structured in such a way so that they are built at times of economic growth and can be used at times of economic downturn, and also are built depending on the importance of the institution. So systemic institutions are required to build higher buffers than non-systemic institutions because they are considered to be more important for the economy of the country, so that it is important for them to remain safe even in periods of unexpected and adverse shocks.
Okay, so I understand that reserve capital is crucial for a bank's stability, and we've seen great examples of this. Actually, we've seen an example in Cyprus with the recent haircuts of deposits in 2013. So I believe the public might not be fully aware of the mechanics of how you build this reserve capital. Can you please explain and elaborate a bit further on the role of reserve capital and how it's built, and maybe bringing in the discussion the importance of the trade-off between holding large amounts of capital? So as I understand, traditionally, as you mentioned previously, the banks were holding only 4 to 6% in the US. Now they're expected to hold much more. There must be a trade-off in this.
Well, capital is there to absorb losses, and it's important to make a distinction between two key concepts. One is the expected losses, and the other one is the unexpected losses. So whenever a bank makes a loan, it calculates that there is a probability that that loan defaults, and always creates a provision for that loan, which is the expectation that there might be a loss. Delving a little bit deeper into the mechanics, the lending that banks do is categorized in three key categories: stage 1, stage 2, and stage 3. Stage 1 and stage 2 are performing loans, as we call them. Stage 3 are the non-performing loans. Now, for stage 1 loans, the bank is required to provide what it expects that a client may lose, what it expects it may lose from that type of lending over a period of 1 year. Whereas in the case of stage 2 and stage 3 loans, which are the most, let's say, riskier loans, the banks are required to provide what it expects to lose over the lifetime of the loan. So these are the provisions. These are the provisions that they go through the financial statements, and whenever a bank makes a lend, it always has a provision set aside for that type of loan in case there is a loss. Now, the other concept is the concept of unexpected losses. So these are losses which will happen only in extreme events. And in order to safeguard against those losses, the banks hold capital. So capital can be the form of equity, the equity that the shareholders of the bank have. It can be in the form of some types of instruments that are bail-inable, so that they can absorb losses in case of stress. And all these are there in order to safeguard that even in the case of unexpected losses, there are multiple levels of instruments that can absorb losses before a depositor is affected.
I mentioned before that I will come back to stress testing, so I think now is the time. So what is stress testing, and how does this affect the strategic decisions of the leadership of a bank? Also, how is it used by the regulator?
Okay, stress testing is a key tool. It's a key tool that is used, as you rightly said, both by the management of banks, but also by the regulator, to see how a business, a bank, as a business, will perform in a situation of an adverse but plausible event. Now, banks employ this tool internally, so we come up with extreme scenarios, and we play them out to see how those scenarios can affect our business in terms of capital, i.e., what losses will be created if the situation happens, but also what liquidity, how liquidity will be impacted if a certain event unfolds. Now, that on the one hand is used as a check to see if our existing capital and liquidity is adequate to meet a stress situation. But on the other hand, it also gives us insights of how we can improve our business so that it is less prone to be affected by an unfortunate situation. So these are the internal scenarios, and there are two well-known exercises that are conducted by all banks: the ICAP, internal capital adequacy process, and the ILAP, internal liquidity adequacy process, which are conducted periodically, and are also tested by the regulator to see that banks do have the methodology and the ability to conduct those exercises, and then they have learnings that they can take out of those exercises. For example, if there's a key strategic decision, usually banks perform both ICAP and ILAB exercises to see how that strategic decision will impact their business plan, and how that strategic decision will impact their business plan, even if it has to face a stress situation. So that's the internal part. There's also the external part. I mean, the European Central Bank performs the so-called EBA stress test every 2 years, which is EU-wide. It presents banks with a scenario, and it requires them to run this scenario and checks how that scenario will be affecting their capital and how it will be affecting their liquidity. The banks which perform poorly are usually required to hold higher capital and higher liquidity buffers so that they can withstand even that extreme scenario.
So EBA brings thematic stress tests. So I believe 4 years ago was it that it was a climate
Correct.
Thematic stress test. So
Well, there's been a thematic stress test on climate, as you very correctly said. There was one on cyber as well.
yes.
So the regulator, and then the same goes with banks. I mean, we try and develop scenarios which will be relevant to the situation that we face today and the risks that we may face in the future, however extreme those risks may be. It sort of reminds me of the exercises done in the army, whereby you have a scenario and you run through it, and by running through it, you both understand how that can impact your business, but also develop the methods to counteract or how to manage the business and how to react to a scenario, and in that way be ready to react quickly if the situation or a similar situation materializes.
Thank you very much for this. So just to join everything that we discussed previously as well, we discussed about buffers and why buffers are important, why they were increased, the capital adequacy ratios and all that, how they increased since the financial crisis, and now basically with the stress testing, as I understand from the explanation you just gave, actually looks at extreme but plausible scenarios and how these ratios are affected in the end through the ICAP or ILAB, even through the EBA stress testing. One of the traditional risks that we discussed at the beginning is liquidity risk. Can you explain a bit how the liquidity management is, why it's crucial for a bank, first of all, and can you join it now with and give us some insights maybe on how a bank manages this liquidity risk in the last few years where we've seen increased interest rates across the globe?
Yes. Well, as we've said, banks traditionally, they borrow money from their depositors short term and they lend long term. And it is crucial for them to have adequate cash reserves to meet ongoing demand by their retail and business clients. Now, Cyprus has traditionally been a very liquid market. There is more than 50 billion in liquidity in a country which has a GDP of a little bit over 30 billion. So banks have been fortunate in Cyprus that there was no real problem to raise liquidity. It was more of an issue of managing this liquidity so that they can smooth the income they have. And I can explain further, during the high interest rate environment that we faced post 2023, it was simple for banks to deposit their cash reserves with the European Central Bank and receive 4.5% in interest rate at some point in time. Well, that was short term, and they knew that was only going to be for a short period of time. As we've seen, interest rates have significantly decreased and are projected to continue decreasing. So a key decision for banks at the time was to switch from that deposit facility with the ECB, which was a simple way of making money, into a longer term investment in other instruments, for example, government bonds, which could secure a stable source of interest for a longer period of time, even when interest rates started falling back into the normal levels. This is the importance of liquidity management. It is an exercise of smoothing interest income of banks on the one hand, and on the other hand, of maintaining adequate reserves to meet ongoing demand by clients.
Just if you allow me to add here as well, that's the issue that we see in times of unrest. Is we see depositors rushing to the bank, doing what's called a bank run, trying to withdraw all the money that they have there, but that action actually enhances the issue. And because we are talking, as you said at the very beginning and just now, we are trying to manage short-term liquidity needs with longer-term loans, borrowing, giving out to the clients. So when the short-term liquidity needs arise significantly,
over a short period of time, that can cause a bank to actually fall. And we've seen that in the past, and we've seen it recently as well.
Well, trust is a key principle for the smooth operation of the banking system. The depositor needs to trust that the bank can safely maintain their wealth, and they can return that wealth whenever it is needed. And when trust fails, that's when we see bankruptcy. This is one of the key reasons why the banking system has the so-called deposit guarantee system. The deposit guarantee system is there to provide the retail depositor, which is the core provider of liquidity for banks, commercial banks. So it is to provide them with the comfort that their money is secure, and that security is not only because of the institution which holds the deposit, but because of the country which guarantees the system. It is this guarantee which has a social burden. If banks fail, then the country or the taxpayer will need to pay for the guarantee that it offered, and it is that risk that has created the very strict regulatory but also legal regime under which banks are forced to operate. And it is for the creation and maintenance of trust.
So, Dimitri, you touched now on the liquidity management, you touched on the liability side, the deposit. So can you tell us a few of the major factors basically driving the deposit rates in Cyprus?
Okay, well, the key, it's a demand and supply question. On the demand side, there is few banks in Cyprus which compete for deposits. On the supply side, the Cyprus market is a very liquid market. So that by itself explains why deposit rates in Cyprus are lower than in some other European countries. Now, in addition to that, banks in Cyprus are primarily funded by retail deposits. Retail deposits are the less demanding and more sticky type of deposits for banks versus wholesale deposits by large institutional investors, which are quick to switch between banks or instruments in order to take advantage of even small changes in interest rate. In addition to that, in the European Union, we do not have a well-developed capital markets as we've seen in the US. And what I mean by that is that depositors, especially retail depositors, have fewer cost-effective options to invest their wealth versus in the US, and in that way, they usually maintain their wealth in deposits. In Cyprus, you know very well that traditionally Cypriots like to hold their wealth either in bank deposits or in real estate, whereas in the US, for example, a big part of the wealth of an individual is usually in their investment products and in their pension schemes. That is one of the reasons why the European Union is, and the European Central Bank in particular, is pushing for a common and advanced European capital markets union. This will offer more options to retail depositors, and it will lead to a more efficient funding and liquidity market.
So it's
having said that,
financial literacy you're talking.
Exactly. Having said that, the having more options will require people to understand how these various options work. So financial literacy here is key. Financial literacy is key so that people can understand the various instruments in which they can place their wealth, different instruments have different risk return characteristics. A bank deposit, which can be the safest form of storing your wealth, usually has a lower return. Whereas other instruments, like for example, mutual funds or bonds or private equity funds, can offer higher return, but for a higher risk that the individual needs to understand. And that is on the storing of wealth side. Financial literacy is also key on the lending side, where individuals and businesses have the ability and the skills to understand how much they can borrow, for what, under what conditions, for what periods, so that they can ensure that whatever they borrow to invest or to spend, they have the ability to repay, even in a period of financial downturn or stress. And this is, and I'm glad to see that the CFA Society in Cyprus has taken a prominent role in promoting financial literacy. I think financial literacy safeguards the financial system. It makes it less prone to shocks. It makes both retail individuals and businesses less prone to be affected by bad news and gossip and lead them to abrupt decisions, and which basically create situations of loss of trust in the financial system with very serious consequences. And well, I mean, kudos to you and to the people who are involved in the board of the and in the various committees of the CFA Institute for promoting this. And maybe
thank you. Well, actually, yes, financial literacy is one of the pillars of the society. This is a living embodiment of financial literacy. This podcast that we're doing now, the podcast series was established this year, and this is going to be the fourth episode of the series. We've seen the first episode touching upon pensions, the second one it was on the Cyprus Stock Exchange, while the third was on investment funds that exist in Cyprus, the various options, etc. So yes, we take financial literacy at very high respect. We are making a lot of actions on this. We are a member of the KEHAB. The KEHAB is the Central Bank of Cyprus Financial Literacy Committee, promoting financial literacy in general, but adapting the high school curricula as well to include financial literacy items at a young age.
Well, financial literacy needs to start from the education system as well. Exactly. When people learn.
Exactly. We have active actions on this. We've delivered presentations on financial literacy with private and public schools, 1,000 high school students across Cyprus on the financial literacy aspects.
Well, come to think about it, learning about yes, how finance works in school can be more useful for an individual than learning some science that they will never that they will never use in practice. Financial decisions everybody will need to make at some point in their life.
Exactly. So thank you very much again. I forgot to mention that you were part of the board in previous years. And thank you for all your volunteering to our society as well. Thank you, Demetri, for the podcast today, for the episode. Thank you to our audience as well. It's been very interesting discussion and looking forward to more communications with yourself.
It's been a pleasure.